What separates the franchise brands that struggle at 12 locations from the ones that explode to 100 franchise territories and then attract private equity? And why do some franchise systems look promising early but completely fall apart the moment that they try to scale? These are questions I've spent the last several years studying from the inside as an actual business builder. I'm Justin Kaiser, co-founder and CEO of Empire Franchising. And over the past 24 years, I've built businesses, structured equity deals, and helped scale franchise platforms, including taking my own franchise brand from 0 to over 100 franchise territories before an acquisition. Now, if there's one thing I've learned about evaluating dozens of franchise systems over the years, and from working with investors and operators who actually build scalable platforms, it's this. Private equity doesn't invest in franchises. They invest in systems that can predictably scale to 100 territories and beyond. That distinction matters because a franchise brand is not automatically a scalable franchise platform. Private equity isn't looking for a good business. They're looking for a machine. They want a system where growth becomes inevitable once a formula is applied. And when I say formula, I'm talking about capital, marketing infrastructure, operational frameworks, and leadership capable of running a national brand. The first thing private equity looks for in a franchise brand is unit economics that work at the operator level. If franchisees can't make money, nothing else matters. Private equity firms study franchise systems from the bottom up because the franchisee is the engine that drives the entire system. If franchisees are achieving strong unit level margins, if they can realistically reach $500K, sometimes even $1 million in owner earnings, that becomes the foundation for aggressive territory expansion. Why? Because good operators talk. Franchisees help recruit other franchisees. The economics themselves become marketing. But if franchisees struggle, then growth stalls and validation collapses, and no amount of marketing can fix that. The second thing that private equity looks for is replicability. Can this business model be duplicated across markets without heroic founders holding everything together? Many early stage businesses rely heavily on the founder's personality, their relationships, their hustle, their intuition. But PE firms aren't buying personalities, they're buying systems. They want documented processes, standardized operating procedures, training programs, support infrastructure, and technology that allows new operators to step into a system that produces predictable results. This is where many brands fail. The founder built a great business, but never engineered the machine required to replicate it. The third factor private equity looks for is territory scalability. A business might be profitable, but can it logically support 100 franchise territories? That question forces founders to think about geography, market size, operational simplicity, and customer acquisition channels. Some businesses are inherently local, others scale nationally. A cleaning concept might scale across hundreds of franchise territories because demand exists everywhere. A niche boutique concept might only support a handful of locations. Private equity is looking for models where territory expansion becomes mathematically obvious. If a brand proves it can operate successfully in 5 markets, the next question becomes, why not 50? Why not 100? That's where serious valuations begin to form. The fourth thing that private equity looks for is centralized growth infrastructure. And this is one of the biggest mistakes that early franchisors make. They assume franchisees will drive their own growth. That's backwards. The most successful franchise systems build centralized marketing engines, lead generation, systems, CRM infrastructure, brand level campaigns, and sales pipelines that drive demand into the network. When franchisees are plugged into a system that consistently delivers leads, growth accelerates dramatically. And this is where platform level thinking comes into play. At Empire Franchising, when we partner with brands, we focus heavily on installing what we call the growth engine. Because without a predictable franchise acquisition system, franchise growth becomes random. Private equity doesn't invest in randomness. They invest in systems that produce repeatable expansion. The fifth factor that private equity evaluates is franchise sales velocity. In other words, how quickly can territories be awarded without breaking the system? A brand that sells 2 franchises per year is not attractive to institutional investors, but a brand that can consistently award 10, 20, 30 territories annually begins to demonstrate momentum. This is where franchisors must think like platform builders rather than operators, because the franchise system itself becomes the product. Investors begin evaluating franchise development pipelines, lead generation strategies, sales conversion rates, territory mapping, and brand positioning. Once a brand proves it can reliably award territories, valuation multiples start expanding rapidly. The sixth factor is leadership. Private equity does not invest in businesses that require founder heroics forever. They want leadership teams capable of running a network with dozens, eventually hundreds of franchisees. That means experienced operators, strong culture, and governance structures that can support growth. The founder may remain involved, but private equity wants a management team capable of scaling beyond the founder's personal capacity. This transition from founder-driven company to scalable organization is often the hardest step for entrepreneurs, but it's also the step that unlocks real enterprise value. The seventh factor is brand positioning and market category. Investors want concepts that occupy a clear lane in the market. A strong franchise brand solves a real problem, communicates its value clearly, and becomes recognizable across markets. Category leadership matters. When a brand becomes the obvious choice in its niche, expansion becomes easier, customer acquisition becomes cheaper, and franchise recruitment becomes faster. Private equity studies market categories carefully because category leaders capture disproportionate market share. And finally, private equity looks for something that most founders underestimate: strategic simplicity. The best franchise models are operationally simple, easy to train, easy to support at scale. Complexity kills scalability. The more moving parts a system has, the harder it becomes to replicate. The brands that reach 100 franchise territories typically have a very clear service offering, streamlined operations, and technology that simplifies execution. When you step back and look at these factors together, you start to understand why only a small percentage of franchise brands ever reach true scale. It's not because the founders lack ambition. It's because building a franchise platform requires thinking differently. You have to design the business for replication, for territory expansion, for centralized infrastructure, and for investor-level scalability from day one. When those pieces are aligned, something very powerful happens. Growth compounds, franchisees succeed, territories expand, investors start paying attention, and what began as a local business transforms into a scalable platform. That's the path to 100 franchise territories. Not luck, not hype, but systems, economics, and leadership aligned around scalable growth. Now, if you're a founder or an investor looking to understand how franchise platforms are built and how private equity evaluates these opportunities, I encourage you to explore more of the insights that we share at empirefranchising.com. Subscribe to this channel and continue learning what it takes to build something that truly scales.